Good morning. Welcome everyone to today's BetaShares webinar. My name is Cameron Gleeson. I am Senior Investment Specialist at BetaShares. We're delighted to see how many of you have managed to take the time out and join us here today. We hope you'll find this an interesting discussion. I'm joined by Dave Bassanese, and he's our Chief Economist here at BetaShares. He'll be talking about the state of play. And then I'll discuss an Equal Weight Index and talk about applications or investment ideas that you might like to consider for your own investing goals. Now, I will say that we've seen a lot of support and interest in our S&P 500 Equal Weight ETF, and clearly by the numbers on this webinar today, we can tell this is a very topical exposure. So we certainly hope you find the information presented here today both relevant and actionable. If you could just take a moment to review this disclaimer slide. All information disclosed here today is general in nature. Please seek financial advice from a professional financial planner. And this is certainly not a recommendation. Go to our PDS for more information about QUS, the BetaShares Equal Weight ETF. Of course, a recording of this session and slides will be emailed to you later on today, so you'll be able to review all this information, or if you have friends that weren't able to join us, they can view that information later. And within your go-to webinars widget, you will see a little toggle box as shown on screen there that allows you to pose questions as we go through the slides. So please click on that, type in any questions. We're going to try and allow as much time for David and myself to respond to your questions. As I'm sure many of you will be aware, our BetaShares is current themes, product information, fund information, and obviously we have our Chief Economist newsletter, which you can subscribe for. And I'd also encourage you to follow us on social pages, those networks shown there. We are about to bring up a poll for you here today. We thought we'd get some engagement from the audience. That poll should be coming up shortly. And the question for that poll, which I'll preempt, is, there we go. How are you currently investing in the US market? And we've allowed for 4 options there. So our options are US broad market or market cap exposure. So ideally, we're talking about a passive exposure there. You may be using direct allocations to shares, so investing directly in companies themselves. You might be investing in the NASDAQ 100 index, and we've got the ticker code there for our NDQ, our ETF that tracks that index. And others may not currently be invested in US equities and might be looking to this webinar as an avenue to learn more about investing in US equities as an asset class. Give you some time to respond, and when the results are available, they should pop up on screen. Interesting. So, okay, so what we see there, actually, it's quite interesting that the proportion of people, not currently invested, relatively high. So I gather that people are able to select more than one answer there. Otherwise, that should add up to 100%. But a large portion, obviously, not invested, 40%, which obviously you're not likely to select the second option if that was your choice. But many people using broad market exposures and NASDAQ, which is obviously a great growth exposure and has had really good performance, smaller proportion investing directly. So that's interesting. And just to reintroduce myself, my name's Cameron Gleeson. My role here at BetaShares is to assist clients of all shapes and sizes with investment strategy and portfolio construction, focusing across all asset classes. I'm joined by David Bassanese, our Chief Economist at BetaShares. David, as I'm sure many of you already know, is a former OECD and Federal Australian Government Treasury economist and a former AFR columnist. Welcome, David. David's here to talk about US equities. Where do we currently see it and where to from here?
Thanks very much, Cameron. It's great to be with you all again for what is, I think, a very interesting new exposure that we're introducing in terms of the US market. In some respects, a bit of a complement to some of the other exposures we have, like the NASDAQ. But my task today is to really give you just a quick update on the US economy. Obviously, we're talking today about investing in the US market. It's the world's leading market, of course. It still drives global markets, still drives global growth. So what goes on in the US is vitally important, not to just the US, of course, and your investments in the US, but to the whole world. And look, some of the elements that if you did participate in our recent quarterly economic update, some of this will be going over old ground. So I'm really going to be spending around about 10 minutes and then leave a lot of time for questions and certainly to Cameron to cover the Equal Weight ETF that we're introducing in a lot more detail. So first and foremost, here's like a range of economic indicators on the US that I track. These are some of the key indicators: retail spending, consumer sentiment, housing starts, durable goods orders. And the grey, I guess the tan area there is the period of recession. So going back to the COVID shock last year, the US economy did go into recession. The group in the US, the National Bureau of Economic Research, that do date, or they sort of say, they make these announcements as to when the economy is in and out of recession. They did say with the economy going into shutdown back in April or March, April, that it was in recession, so it is an official recession. And as you can just see how the economic data has panned out, we had that initial collapse, but things have really bounced back. This has been the pretty remarkable story, and when you think about equity markets, is why equity markets have bounced back essentially the way they had is, despite really 3 waves of coronavirus in the US, and 500,000 people dying of coronavirus in the US, the economy after that initial collapse, I guess, is effectively early last year, has bounded back pretty well. So the housing sector is recovering, retail spending. Look, there was a bit of a dip in retail spending over November and December, because there was that 3rd wave of coronavirus did see new social distancing restrictions introduced into some cities, which has taken the edge off spending and employment. But the rate of new cases in the US has peaked, it's coming off. And obviously the vaccines are now rolling out as well. So fingers crossed, I think we're past the worst in terms of coronavirus, and we're unlikely to see, base case would be not a major 4th wave of coronavirus and renewed lockdowns in the US. So the outlook is pretty encouraging. And also on top of this is that the Biden, President Biden has still got a $1.9 trillion stimulus program, a chunk of which is $1,400 checks to be sent to virtually every household, apart from the very, very high income households, over the next few months once that gets through Parliament. So that's going to the Congress. So that's going to help support growth this year as well. So look, the outlook for the economy, I think, is pretty solid this year, which is good news for equity markets and good news for global markets and good news for the US market in particular. Another, I guess, positive, and thinking about what's going to drive the economy this year, consumer spending. Just on the next slide, you can see this is the household savings rate. And initially at COVID, you can see it's been running between 5 to 10% historically for a number of years. So that's the percent of household income that is not spent but saved effectively. And you can see with the shutdowns and the collapse in consumer spending initially, it surged to very high levels because spending dried up. Spending has recovered, and we've had a big increase in income because of the fiscal support from the government. And as you can see, the net effect of that is the savings rates come down, but it's still well above its the longer run average level there. So households are still cashed up and are able to spend. So this high savings rate plus the Biden stimulus does bode well for consumer spending in the US economy this year, which again, as in Australia, is a big chunk of the economy. Something like 60% of GDP is consumer spending. Just, I guess, some of the one, if you're following the newspapers at the moment, the latest market worry, of course, is interest rates. And just on the next slide there, I've got my chart on interest rates. And we have seen bond yields, particularly in the US, but also in Australia, pick up in the last few weeks, on the view that inflation may pick up in the short run. it may, cause, the bonds need to allow for some inflation premium, and/or it could actually cause central banks to start to talk about winding back their bond purchases, or even, heaven forbid, start to raise interest rates sometime soon. There is a risk that inflation does pick up in the short term. I stress short term, and as a result, we could see a bit of a pickup further in bond yields, and even a correction in the equity market in the short term. But as I said in the quarterly webinar, I think if that does happen, it's not clear that it will happen, but even if it did happen, I think it'll only be a relatively short pullback in the markets, and if anything, maybe a buying opportunity for those that haven't, fully gotten back into the market to the extent that they would like. And I think inflation might pick up because of supply bottlenecks. You're seeing commodity prices pick up. You're seeing some shortages in some markets with the recovery in demand relative to production. But underlying wages growth is still quite low, and unemployment rates are still quite high in the US. So it's not going to be a sustained pickup in inflation. So it may tick up above 2 and then come back down again. And if you look at it, my modelling suggests if the Fed funds rate stays where it is, i.e. the central bank doesn't raise rates and the market doesn't expect them to do it for the following 12 months, and we're at that same expectation at the end of this year, as I expect, then my modelling of bond yields suggests that they shouldn't get much beyond, say, 1.25%, 1.5%. And today they're around about 1.35%. So a lot of that adjustment from having probably gone too far to the downside last year does seem to have already played out. So I think there's not a lot more upside to bond yields. So which again bodes well for the equity market. Just in terms of the equity situation, again, the story here is, again, the pessimists are worried about that high PE ratio. If you look at the lower left-hand side chart there, PE ratio of over 20 times earnings. But if you factor in the very low level of interest rates, still quite low, even 1.3% on the 10-year bond yield, the so-called equity to bond yield gap on the lower right-hand side is just under 4%. So the earnings yield of the market, so that PE ratio, you turn it upside down, you get the earnings yield, which is about 5%. You take away the 1% bond yield, or around about 1%, you get like a 4% equity premium. And as you can see, that's in line with its average over the past decade, and the longer run average has actually been lower than that, about 2.5%. So there's still, relative to where bond yields are, those PE ratios are sort of not overly inflated. And meanwhile, the earnings story is coming through quite nicely. We've had a stabilisation in earnings in the second half of last year, and we've actually been getting earnings upgrades coming through in the US economy. And forward earnings, which is a measure of a weighted average of this year's earnings and next year's. At the moment, next year's expected earnings is anticipated to be quite a bit bigger than this year's, which means that forward earnings will continue to rise. And I see no reason why you should get a big downgrade at earnings. So that bodes well for the economy as well. Last but not least, so within the overall equity market, and this is what Cameron's going to dwell on at the moment, so that's the overall equity outlook, I think, which is still pretty encouraging, notwithstanding some short-run concerns about inflation and interest rates. But within the equity market, one of the key decisions is, if you want to sort of pick what areas of the market you think are going to do better or worse, is this value versus growth. And so growth areas are companies with high PE ratios, high earnings growth. Value parts of the market are those with relatively low valuations, but are seen as relatively cheap. And as you can see, over the long run, growth has tended to outperform, and it actually outperformed, even had a big kick along in the early part of the COVID shock. But growth has started to underperform, and we actually do see this in the early stages of market recoveries, where those beaten down, cheaper parts of the market, if you like, tend to recover faster. And so that is one scenario which could play out over the next little while, where the value parts of the market do start to outperform, at least for a while. So with that background, I'll hand over to Cameron to look at this exposure in a bit more detail.
Thank you, David. So I'll be introducing the S&P 500 Equal Weight Index. We'll talk a bit about the index and index construction, so you've got a good understanding as to what goes on under the hood. And we'll look at historical returns, historical performance. But I think what's really more important than the historical performance is really what are the drivers of those returns? What are the characteristics that you get out of this index? And therefore, how can you use it within your portfolio? So, what is the S&P 500 Equal Weight Index? Well, the Equal Weight Index was launched by S&P back in January 2003. Now, I'm sure that you'll all be familiar or will have heard of the S&P 500 index. That's the market capitalization weighted index, where all top 500 companies from the US equities are weighted by their size. The Equal Weight Index is a far simpler concept. It's simply to take those top 500 companies and give them all exactly the same weight on rebalance. And being 500 companies, that means that each company has an allocation of 0.2% of the index at each rebalance date. Now, to talk about the dynamic after rebalance, obviously we'll have some stocks in the index which will outperform, and their weight will increase from 0.2 to a slightly higher figure, and other stocks will underperform, and their weight will be slightly reduced as a result of that underperformance until the next rebalance date, which is in 3 months' time. And at that point, we'll sell out of part of our winners, buy more of the losers to bring their weights back to 0.2% at the rebalance date, and we go again. If you think about an equal weight exposure as opposed to a market cap weight exposure, you would suggest that an equal weight exposure is a true representation of the average return of the US equity market, as opposed to a return skewed towards the really big end of the market. We'll go through some of that. To look at historical performance, and clearly an equal weight strategy is giving you exposure to US equities. But I think for context, it's important to compare equal weight to the S&P 500 market cap weight to understand the characteristics it offers. And here we see two charts that show performance of the equal weight in orange versus the market cap weight in gray. The chart on the right-hand side shows the performance of the Equal Weight Index since its inception in January 2003. On the left-hand side, you see a chart of the S&P 500 Equal Weight Strategy versus S&P Index going back to 1970. Now, as I mentioned, the index was launched in 2003. So data before that point within this chart is back-tested data because the index is a rules-based approach. S&P can apply those rules historically to create that time series. So, I think, it's important to note that it's good to look at long-term returns. We do see that when we go back through the 70s, we see obviously a number of other cycles, which is also useful. But in both charts, we do see stronger long-term returns as a result of holding an equal weight exposure. So, the obvious question is, well, what's driving that outperformance? And the starting point, or the key point in terms of the return differential, is that equal weight has a smaller size bias. So to look at that, we see the cumulative allocations, the allocations to stocks in particular segments or particular size stocks of the market cap versus equal weight indices in the bar chart below. So let's take the largest stock on the left-hand side. So that stock is Apple. And at the time of this data, Apple represented 6.7% of the market cap weighted index. So, nearly 7% of the index. Obviously, from an equal weight perspective, only 0.2% of the index. Let's go down the other end and compare that to the bottom half of the top 500 stocks. So what you describe there as the smallest 500 companies. The market cap index has only an allocation of 11.3% to those bottom half of the 500. So that's the equivalent to the current weighting of Apple and Microsoft, the two largest companies, represent slightly more than the smallest 250 companies. And that gives you an idea of the skew in behavior and return as to how a market cap weighted index can really be skewed to that top end of the market. As you'd expect, being an equal weight approach, 50% of the exposure for an equal weight index will be dedicated to that smaller end of the market. So an equal weight approach gives you less sensitive exposure to those mega cap names, those tech names, as I mentioned, Apple, Microsoft, and alike, and a size bias, as we describe. Now, I do want to say, just from an Australian investor's perspective, we're still talking about a size bias within the large cap segment of US equities. So every stock in the top 500 is considered large cap. It can be difficult to think about this from an Australian perspective because US capital markets are absolutely, outrank or outscale Australian markets. The 500th largest stock in Australia wouldn't be considered large cap, obviously, not even small cap. It's a micro cap stock. US equity markets, far larger, far more liquid. All of these stocks would sit well within the top 100. The least liquid names in the S&P 500 are trading as much on a daily basis as Coles in Australia, which is our 27th largest stock. So very efficient liquid markets that we're dealing with here. I just want to show you this slide, and look, this contains a lot of data. S&P do a great job of providing analytics and describing the characteristics of each of their exposures. And you can access this for any S&P index online. These are the characteristics of the S&P 500 Equal Weight Index. And there is a lot of data here, which you can have a look over at a later point. But I'll just draw your attention to the wagon wheel on the top right. What this shows us is the characteristics of the equal weight exposure relative to the benchmark, being the market cap weighted exposure. The market cap weighted exposure is represented by the yellow dotted line, and the green shape represents equal weight. So, for example, we talked about the small size skew of equal weight. So we see there that equal weight has a bias towards small size. But we can also look at a number of other factors that drive returns. For example, momentum. As I talked about with an equal weight strategy, at rebalance, we are selling down stocks that have increased their share to more than 0.2 and buying more stocks that have fallen below 0.2. That is described as a mean reversion strategy, or a strategy that benefits from lower momentum in stock prices. And that's another key contributor to the performance of equal weight. So as we see there, the momentum profile of equal weight is less than that of the broad market. And obviously, another characteristic we can see there is value. Equal weight strategy has more of a tilt to value stocks than market. We can also see from a sector basis, the allocation to IT. So if we look at the bottom right, allocation to, for example, IT and communications is less than that of the market cap weight. So look, that's all really nice in theory. I think it's really important to look at the practical implications of these characteristics. And we've got a really good case study in 2020. So if we look at the chart below, the first 4 bars on the left show the returns for a number of indices from Q1 to Q3 of 2020. And look, we all remember what that period was like. In that period, large growth-oriented companies with strong momentum dominated. And here we're really talking about predominantly the tech stocks. So these companies were better able to handle the disruptive environment and manage the move to a work and play from home sort of economy. In comparison, equal weight, as we see there, actually returned a negative figure. So it's a negative 4.7%. Equal weight companies, being smaller, tend to have more exposure to economic activity. So real world economic activity, bricks and mortar activity. As a result, they drew down. If we fast forward to the 4 bar charts on the right-hand side, we see what happened from Q4 through to January. Completely flip side of the original, 3 quarters of the year, really. We had the announcements of vaccines, the rollouts of those vaccines, and this all had very positive implications for the outlook for economic growth. And given an equal weight strategy has more leverage or sensitivity to economic growth, equal weight outperforms from around about the start of November. Equal weight started outperforming over and above those sort of large cap growth-oriented segments of the market. Another really critical point to look at, and I think this is really important when looking at your portfolio and using equal weight, is what's happened to equity market correlation. So If we look here at the weight of the top 5 companies in the S&P 500 market cap index, we're really at an acute point at the start of 2021. So obviously that accumulation or the run up in concentration has occurred by those mega cap tech names performing so strongly. And we look at the level of concentrations now over 21, 22, 23%. We haven't seen levels of concentration in top 5 stocks like this since the 70s. And then all of these stocks are all in the tech space. So, very concentrated and you would suggest a risky situation to be in. So that's all shown by the gray in the background. If we look at the orange line, what that shows us is the cumulative outperformance of an S&P 500 equal weight over and above market cap weight. So this is when equal weight does better. Now, it makes sense, right? Like when you have periods when concentration is increasing, for example, in the dot-com bubble buildup, we see that the outperformance of equal weight is reduced, or we see underperformance in equal weight. But again, when concentration subsides based on the size profile, equal weight begins to outperform. So for example, concentration subsiding throughout the 70s, again after the dot-com bust, GFC, concentration reducing, equal weight has outperformed historically. So look, that's looking at the top 5 stocks, but we can also look at the market as a whole more broadly and look at sectors. So it's important to note that equal weight as a strategy does not necessarily mean equal sector weight, but the sector profile of an equal weight strategy can be very different, and it is very different to the sector profile of a market cap index, particularly when we look across time. So the chart on the left-hand side shows that sector profile over time for the market cap weighted index, and that clearly is being influenced by, as I would describe it, as more heavily influenced by bubbles in the market, as opposed to the equal weight strategy, which has a very consistent, even, and actually, quite an even spread of its sector profile breakdown. Looking at the S&P 500, if we look at the tan color, that represents information technology in the lead up to the dot-com bubble. Clearly, IT companies, sort of increased their share of the market cap weight, and then we see as a result of that reduction in their weight, the outperformance occurred in equal weight as a strategy. Again, in the lead up to GFC, financials increased their weight. Subsequent to the GFC, we did see equal weight again outperforming. So a more even sector profile, and I'd suggest less susceptible to bubbles in particular segments of the market. So now what we're going to do is really look at some ways that you might consider using an equal weight strategy within your portfolio. Just to recap, I describe equal weight, an equal weight strategy, an equal weight US equity exposure as something that provides you an exposure which is reducing your concentration, particularly in large cap US equities, where we've got those mega cap names dominating. It's a strategy that has a skew or a bias towards the smaller large cap stocks, albeit you're not playing in that less liquid small cap market. It benefits from mean reversion and also from leverage or sensitivity to US economic growth. And as we'll see in the next few slides, it's an excellent tool to use in combination with other investments that you may well have in your portfolio. So we've got a number of potential use cases for S&P equal weight. And the first of them is, possibly the most obvious. S&P 500 equal weight can be used as your core US equity allocation, so long-term core holding. And we see in the US that a lot of investors will use S&P 500 equal weight in lieu of S&P 500 market cap, or indeed active managers. And that's certainly borne fruit in terms of the timeframes shown here. We see, obviously, equity markets in the US have performed very well over this period, but equal weight certainly has outperformed. We see the value of $100 growing there over roughly 25 years to 1,300 for equal weight versus 1,000. So 30% better outcome over the journey as a result of that strategy. So that's a long-term core holding. Another option in terms of looking at adding an equal weight exposure is to use it as a satellite or a tactical exposure. And this is typically taking a more short-term or medium-term view. So if you are of the view that we are about to enter or have in fact commenced a period of economic recovery in the US, you might choose to use an equal weight approach over a market cap weight approach. And we can look at historical data here, and the chart here shows the shaded areas of US recessions going back from 1990. So there was that early 90s recession. We again had a recession in the early 2000s, the GFC recession, and most recently, the COVID-induced recession. The blue line shows that relative performance. When is equal weight doing better than market cap? So when that line is increasing or going up, that's showing periods of outperformance. You can see clearly during periods of economic recovery directly after recessions that equal weight's outperforming. So, people will choose to invest in US equities if they expect that the economy is recovering. You can add alpha by simply choosing an equal weight approach to getting that US equity exposure. Now, the third implementation approach, and I think this is really useful because we know that a lot of Australian investors already have US exposure, is really to look at complementing your existing exposure with what we describe as a barbell approach. So if we see the chart shown here on this slide, we can see that there are 4 exposures, and this is showing the total returns of these 4 index exposures. So the first one is the NASDAQ 100 index. There we have the S&P 500 equal weight index in dark orange, the S&P 500 index, which is shown as dark gray, and then in lighter gray we see the NASDAQ 100 S&P 500 equal weight blend. So that is a 50-50 blend of NASDAQ and S&P 500 equal weight. Now the period shown here captures 25 years, includes .com, includes GFC, includes COVID, and also includes the strong run-up that we can see there, particularly in the NASDAQ, over the last 5 years as growth and tech have really come to the fore and performed very strongly. And we do know, we see investment inflows, and we know that a lot of Australian investors have been allocating to growth and tech over the last 5 years, which has resulted in strong returns. If we look, people are using ETFs. One example, obviously, as I mentioned before, is our NASDAQ 100 ETF. They're using active managers that have a tilt to growth, tech, or quality. And so people are participating in this. Given where we're at and the risks in terms of the cycle, this is where an equal weight exposure can really work well with that growth exposures within your portfolio. If we see on the sort of top right-hand slide of this chart, we can look at what the profile is of tech and growth, or what the profile of NASDAQ is versus equal weight. So NASDAQ has a profile which is exposed to or leveraged to secular growth. So that's long-term structural growth. NASDAQ has a tilt towards mega caps or large caps, and it is a momentum strategy. If we consider equal weight, well, it's actually the polar opposite in terms of its return profile. Rather than secular growth, we're talking about shorter term economic cycles, so cyclical growth. It has that smaller size bias, and it benefits from mean reversion, which is the opposite of momentum. So we're really talking about 2 competing, and from a portfolio construction perspective, we call them complementary exposures. Because these exposures can behave very differently, they have a very low level of correlation. And that's an excellent starting point if you're trying to build diversification in your portfolio. Now, I'll talk about this in numbers, but we can just talk about it generally as well afterwards. If we look at the blended NASDAQ equal weight exposure in the bottom chart, the volatility, the average volatility of the 2 component parts of this barbell approach is the blended volatility is lower than the average. So you've reduced your volatility. But with that blend, if you're periodically rebalancing, you actually benefit from that rebalancing effect. And your average return of the 2 components is actually improved through this exposure, this blended exposure. And so we've done two things. We've improved returns and we've reduced volatility. And what that does is that improves your risk-adjusted returns. That's described through what's known as the Sharpe ratio. And that's shown here on the bottom of the chart. We see Sharpe ratios for the NASDAQ and equal weight. And clearly, the Sharpe ratio of that blended portfolio is in fact better than both of the individual components and better than the broad market. So that's a really good outcome. Another way to just describe this in more simple terms is what this blended exposure has given you is a growth profile. If we look at the chart, very similar to that of the NASDAQ 100, that strong performance over the 25-year period, but at a level of volatility or risk much closer to the equal weight portfolio, or indeed closer to the S&P 500 portfolio, which is lower volatility. So that's a really great outcome. So you can access the S&P 500 Equal Weight Index that we've talked about here today through BetaShares S&P 500 Equal Weight ETF, which is available on the ASX with the ticker code QUS as shown on the screen there. QUS tracks the S&P 500 Equal Weight Index by buying all of the stocks in that index in their allocations as described by the index. So this is a low-cost passive approach, and as you'd expect, comes with a low fee, 29 basis points. Of course, there are risks with all investments. QUS is no different. Investments can go up or down, no guarantees on future performance. The information that we've provided here today is general in nature, and we have not taken into account anyone's personal, financial, or other circumstances. Look, I'd really encourage you to go onto our BetaShares website. It's a great resource for learning more about our funds. There's a tag there at the top called Our Funds. If you are interested in QUS, please type in the code QUS under Our Funds. You can find the PDS, you can find performance information, you can find applications for this investment, and you can also find on any day the complete list of holdings in that fund updated daily. So I encourage you to go and check out the betashares.com.au website. So that concludes the presentation part of the webinar today. I'll ask David to join me on the camera, and we've got some questions that have come through. I'll just try and synthesize these. So one question I'll just start with is, there's a question here for David. David, can you tell us a little bit about your expectations for inflation, or perhaps what may drive inflation up in the future? And you did touch on this, but
well, I don't think much will drive it up from a longer term perspective. I'm still a big believer in inflation remaining lower for longer. So the Federal Reserve, for example, has a target. The US Central Bank has a target of inflation getting to 2% and staying above 2% for a little bit, but basically wants to have a 2%. It's rarely been above 2% in the past 25 years. In fact, it's been above 2% 25% of the time. So if we haven't managed to do it, in that period, I can't see it happening going forward. And it's because wages growth is subdued, technology, globalization, these structural factors. So longer term, I think the banks are still going to struggle to get inflation up, which means that bond yields will stay relatively low and valuations stay relatively high. That's important. But in the short run, we are, rebounding. We're close to a V-shaped recovery globally, and particularly in the US for growth. As demand has rebounded relative to supply is slowly catching up. There are reports of, anecdotal reports of pricing pressure in some areas. If you look at producer prices in the US, they've gone up. So wholesale prices, some of that will feed through into consumer prices in the short run. So that's really the only sort of risk, the short run risk. And obviously, if you look at commodity prices, things like copper prices are going up, iron ore prices, obviously. But again, services these days is a big chunk of GDP. It's not manufacturing to the extent it used to be, many years ago. So the transmission of even that sort of pricing pressure is still going to be pretty muted. But nonetheless, I just highlight that as a risk over the next 3 to 6 months. That if you do get I guess a spike higher or a pickup, whatever the word should be, that could be an opportunity for markets to pull back somewhat.
Great, thank you, David. So there's some questions here which I can run through relatively quickly. There was a question about, do you physically buy all stocks in the 500? No tracking error on rebalance day. So that's correct. We replicate the full S&P 500. A question about currency risk, and there's also a question about whether there's an unhedged version, a hedged version of this index. So you are QUS is a unhedged exposure. So if the Australian dollar was to appreciate and the US index was to remain flat, then that will lead to obviously underperformance, and vice versa if the Australian dollar does depreciate. Question also about, instead of using a blended strategy, why not use a timing strategy to switch between S&P 500 and NASDAQ 100? And look, I will say that if you're able to use a timing strategy, that may well have some applicability. It's worth pointing out that the S&P 500 is slowly converging on the NASDAQ in terms of its behavior, and it's now quite correlated to NASDAQ. But I would also say that, in my view, and this is my personal view, it is very difficult to time markets. So if you can choose two exposures that complement each other, that means you can blend them and hold them over the long term without trying to, if you like, guess or predict when we're going to have a switch in regimes. So look, there is a range of questions here. We've got a lot that we could go through. I think that there's a number of comments here on rebalancing. The income profile, someone's asked about what the income profile of QUS is. It is biased towards dividends or higher dividend stocks, so it produces a higher level of income than the US equity markets as a whole. And having a slight value tilt or a cyclical tilt, it will have that income bias. Okay, look, we've got, I can't tell you how many questions here, but we'll go through a few more here just to keep us going. Do S&P 500 have a growth ETF? Not in Australia. If you're looking for growth, there are other avenues. I'd suggest our NASDAQ is a good answer there. And what percentage share of each ETF, NDQ and QUS, when utilizing them as a strategy? So I guess the question relates to that barbell approach. How do I decide what balance of QUS and NDQ to use? Look, that depends on the risk profile that you want to hold. The example I use is a 50-50 approach to remain sort of neutral against those two return profiles. You don't have to use that approach, but that's what I've shown there within those slides. And how does this index compare to the Russell 2000? That is a small cap index, the Russell 2000. While, as I mentioned, the QUS and the S&P 500 equal weight has a small size bias, we're still talking about the largest stocks or large cap stocks. Okay. Yeah, so look, we do have a number of questions there that we're not going to have time to get through. I know that my colleagues have been answering these as quickly as possible online. We've been flooded. We will try and get you relevant answers afterwards where your questions haven't been addressed. We'd just like to take a moment to thank you for joining us and also for supporting us, using our funds. We hope that you've found that our funds are true to label, really good access point, and that you've had a positive outcomes. For anyone who's not yet looked at using our BetaShares funds, please visit the website, reach out to us. We're happy to help. We're here to educate and help people with their investment journey. Thank you very much, David.
Thanks a lot, Cameron.
Have a good day.
Bye, everyone.